Mode.
All aboard. Next U.S. index train leaving Central Station. High speed super train. Next stop. Well, we're kind of working on it, but have your tickets ready. Hey, folks, Trader User Group weekly roundup here for you for the trading week ending Sept 21, 2018. Before I get into the individual charts here and just kind of go through where we are, we've seen the Dow finally catch up to the rest of the U.S. index market. Now, as I was telling our members, I suspect that we knew that the indexes were going to get back in alignment again. What we didn't know was which was going to move where. But watching the Dow over the past couple of weeks, I was talking about buying the dip primarily if you wanted to do a pair trade, going long the Dow and possibly short NASDAQ, because NASDAQ was the free leading index this year, and the Dow was the laggard. But clearly, they've made this past week they've kind of reversed trends, right? I mean, we've seen that happen. Now, this past Friday, it was triple witching. We had futures, options on indexes, monthly expiries. They all rolled over, and it was the fourth highest trading volume day of the year, really. And also we had the some sector changes as well, where we've seen this new sector become official on Monday, XLC. They've added into it Facebook, Netflix, Google as a communication sector, which before had a bunch of really exciting stocks like AT&T and Verizon. So that sector is going to be moving around. So you've seen big money move some of their sector allocations around. Some of them have already started doing that weeks ago. So it wasn't all on Friday, but there was probably more of it on Friday, holding it out to the end. We also see some changes in the XLK technology sector, moving more chip makers in there, some software companies as well. So all of that told really brought trading volume this past Friday to one of the highest that we've seen all year. Now, with the Dow playing catch up and making new all-time highs this year, we've also seen corporate earnings, corporate growth, consumer optimism, small business optimism at decade highs. I mean, this is a very, very strong economy here in the U.S. We've also, that's been augmented by the tax cuts. We've seen, I saw a report where U.S. corporations have repatriated, I think in Q1 of this year from offshore, they brought back 225 billion. I think in Q2 they brought it down to about 105 billion. There's about another estimated 170 billion to go before the end of the year. And a lot of the companies have been doing a lot of stock market engineering where they're buying shares back. So share buyback takes float off the market. It tends to increase your earnings per share based on how the calculations work. So they've been doing that. And they've also been plowing money into dividends, and they've done employee bonuses as well. So we've seen that goose the business community very nicely. Next week on the, what is it, the 26th, I guess, of September, we've got all but assured rate hike of 25 basis points by the Fed. And then again on December 19th, another 25 basis point rate hike. I think it's like a 97% chance next week and almost an 80% chance for December. So those are pretty much baked into the current prices. Where everybody is going to be watching is where to from here. And economists, not to be outdone and to be outshined intellectually, from Goldman and Morgan and some of these other places, they come up with this term called the R star. I can't make this up. But really, it's the same thing that economists have been looking at for years, which is the real interest rate over the current inflation rate. It's kind of like the nominal rate or the real Fed's funds neutral rate. So if you take inflation and then you compare it to the Fed fund rate, they don't want the Fed fund rate to be that much higher than inflation. It's been negative for a while. And the projection is it'll probably go positive. But if you do the math and you figure all this stuff out, it projects, the economist projecting about another 4 rate hikes to get the markets into what is deemed a quote unquote neutral interest rate mode. Okay. I've been saying that the rates are at least 1 to 1.5 points cheaper than where they should be right now. They should be at 3.5 to 4%. The economists are saying that it should probably be up another 1 to 1.5%. Now, the issue is that's assuming inflation stays where it is. We've got this whole issue internationally where if we do see a rise in inflation, it can take off strongly globally. And then that would force the Fed's hand to start pumping and driving interest rates even higher. And then you're going to get interest rates. And this whole concept around risk premium comes into play about should I put my money in equities or should I have them in bonds and government debt and what's deemed a risk-free trade, right? So that is what we've got coming up here over the next year or so. At least that's what the big money is doing. They're looking 6 months out and how should they do their allocations? Where should they put their money? And for us, we're trading day to day, week to week. So on any given day, flip a coin, the markets can go up, the markets can go down. But if you're trading a little bit longer term, you're going out more than 30 to 90 days, and you're looking at where are we going to be, then a lot of it is going to be dependent on some of this inflationary data that we're going to be getting and some of the things that the Feds are doing. Now, one other point I want to make here, and then we'll jump into the charts, and that's around the balance sheet reduction. The Feds have been on a tear. They've been reducing 40 billion a month from the US balance sheet. Now, when they take 40 billion off, that means when we have auctions every month to sell more government debt to fund our deficit, right? To fund it. Someone's got to belly up to the bar and buy that debt. Well, when the Feds were buying the debt, we didn't have to worry about it. They just came in and bought, right? They print in one pocket and they put it in the other pocket. The minute they walked away, then the big issue was, will someone belly up and replace the Feds? And so far they have, because most of the emerging markets have been really poor, and all the interest rates and all the money has been tied up in the US, coming from Japan and Europe. Well, we're going to start in Q4, October 1st, we're going to go from 40 billion to 50 billion a month that we're taking off. So now more investors and countries and sovereign wealth funds have to step up and buy more debt from the US. That's going to have a tendency, folks, to raise interest rates on its own, regardless of what the Fed funds, what the Fed interest rate policy is. Okay. It's going to move the short-term rates. It's going to move the midterm and long-term rates further out in duration. That is the one thing that has kept our yield curve, which you may have heard about on TV from the talking heads, or if you've been watching and listening here every week, you hear about us talk about it all the time. Keeping the yield curve relatively low. One thing that we saw this week that was really strong, the technology stocks and utilities were in the red for the week. We're seeing some sector rotation as we get towards the latter stages of this bull secular run, and we saw materials finishing up fairly strong. In fact, it was the best performer for the week, primarily on a weaker dollar, because materials is kind of controlled a lot by commodities. But we're seeing some of this sector rotation going on here, out of tech and into some of the other sectors, more from growth into value and things like that. Now, but as I said, the Feds pulling the money off the balance sheet. I saw an estimate. I don't know if it was from Goldman or one of the analysts out there, that the global financial system has been pumping in hundreds of billions of dollars every month into the markets. Remember, the US is really the only country right now of the large economies that's pulling the money off the balance sheet. Everybody else is pumping, from Japan to China in their own crazy way, Great Britain, Europe, and other emerging market countries. Well, when a lot of this money starts coming back off the balance sheet, we're going to see things change. We're going to see sector rotation happen. We're going to see inflation and interest rate correlations start to move around a bit. We're going to see the US dollar move around a bit. In fact, the US dollar this week was down a little bit. And it's really not a dollar, it's more a dollar index. And it was down because other foreign currencies were a little bit stronger. So it's going to be a real interesting play over the next 12 months. All right. I believe inflation is going to be the great white shark that could come up if people aren't very careful. So we're going to follow it very closely. And there are different ways to follow it, but we're going to watch the yield curve. We're going to watch the credit markets, especially corporate bonds and debt, from junk bonds, corporate junk bonds, to investment grade bonds. We need to follow that. Even if you don't invest in that, you need to understand it, because credit and the money markets drive the equity markets, not the other way around. Okay. So what you see on the screen right here is the S&P E-mini futures contract. You can see here the price on a daily chart. Notice I've got three trend lines on here, all in green. You can see the steepness in the trend line, which basically measures the vector, or it's a vector that measures the steepness of the curve. We were on a longer term vector like this. You can see the 200 EMA, this yellow line, is slightly steeper than this longer term trend line. And then we get a steeper vector right here, and then the most steep right here. Typically, as we start to near a peak, the vector increases. So if this is flat line, you can pretty much draw an angle of declination and see that as we go steeper and steeper, that angle gets steeper and steeper until at such point that it can't sustain itself and it pulls back to another one of these longer term trend lines. That is just the way the markets work. We're setting ourselves up now for a little bit of a pullback. All right. We do not have a divergence yet, but the minute we get that cross there, that would give us, for our members, what we call a bed, or a bearish divergence. We're going to watch that because there's some nice trades to play off of that on the time frame that you're using. In this case, we're using the daily chart. Okay. So that's what I'm looking at right here on the E-minis. And then, of course, if we look at the Dow, which I'm impressed, the Dow came back really hard. If we step it out, you can see right here, the Dow came back, and it was the laggard. And we came back and we made new all-time highs on Friday. We actually made new all-time highs on Thursday, and then we made new highs on Friday. So from the 20th to the 21st, we made new all-time highs, 28 or 26,820 roughly, from 26,684, which was the prior all-time high. So we finally taken that out. I do not see any potential divergences really of any note setting up. You can see the steepness of this trend line right here, going really back to June. If I just put it on these closes right here like that, you can see that this right here shows that even though we slapped 10% tariffs on China, there was good news coming out of China when the second in command there, Premier Li, I think, came out and said that they're going to reduce the tariffs for Chinese citizens a little bit to make it a little bit easier to buy. So we're going to see how that all plays itself out. But to any extent, everything is bullish right now. Okay. Any pullbacks we're still in a buy the dip. Now, we've been in a buy the dip since 2017, as I've been telling our members. If you're not a member, I highly encourage you to come in, because we've got a lot of international folks. We look at the markets from a macro perspective, not necessarily just US centric. And that's the way you really want to play the markets, with all the ETFs and the way money is flowing around in the debt market internationally, and currencies. They're driving where money flows. Right now, money is still flowing to the U.S. And so this is the Dow. And if we look at the weakest performer for this past week, it's NASDAQ futures. It was actually down. Okay. And you can see here, we did not make new all-time highs. We've been maintaining this upward vector. We're trying to maintain it. You can see it's fighting it right here. It's been fighting it since September the 6th. Remember, we kicked off the first couple of trading days in September to the downside. All indexes, 4 days in a row, we were down. The first 4 trading days in September. And then everybody's been buy the dip moment up, even the NASDAQ. But the NASDAQ has not been participating and playing as nicely as the other indexes, because we're seeing some rotation and some profit taking. So let's be fair. The NASDAQ has led everything for years now. It has been the top performer, but we're seeing some rotation as the secular trend that we're in right now, bull trend, is getting a little bit long in the teeth. So we're seeing this play here. And we've got a little bit of downside support here. We've set up, we don't have right here, we did not have a bearish divergence, right? So right in this area here, it does suggest we got pretty good support, about 100 points or so south of us in NASDAQ. And then finally, if we look at the Russell actually also, which had led for a bit, it played catch up. Now that it's done playing catch up, look at the vector on the trend line of this one. Like NASDAQ, fairly steep. We're fighting it a little bit. It closed right below it. We've got pretty good support below us right here, but we did not make new all-time highs for the Russell were made in late August on that good strong bull run that we had across all indexes. Now we're getting a little bit of a pullback here. Keep in mind, September traditionally is not a very good month for the indexes. Okay, generally we see volatility go up and we see indexes come down just a little bit in September. It's one of the worst performing months of the year. And speaking of volatility, though, it's been very quiet, very benign. If we look at the VIX is down for the week. And if you look at where we finished, I mean, the VIX, heck, it finished at 1168. Keep in mind that if you look over here in January, all right, you can see where we are. And everything was just going along smoothly. There was no indication of anything. Here was the VIX right here. And if I come over in January, we were right about in that area right there. Okay. Almost the same. If I were to just draw, let me just see if I can't draw that trend line, right? Right in that area there. Okay. And then we went from there up to an intraday high of over 50 in the VIX. And it took really less than 1, 2, 3, 4, 5, 6, about 7 days. 7 days to go from about 12 to 50. And that was on a very strong bull market in January, and it caught everybody by surprise. And that was when interest rates popped 3%, and they looked like they were going to get out of control and start to run. And this also was the big short squeeze unwind of volatility futures. There was everybody and their uncle short volatility, and everybody had to get out of volatility at the same time. And you can see that's kind of where we closed. So these were almost like overnight kind of things, although the VIX doesn't trades a little bit in overnight. But you can see here, that was the mad dash for the rush, and it flushed a lot of people out in that big move here. But needless to say, it went from around 12 up like that on an interest rate scare. Now interest rates are back up over 3%, but it's the rate of movement that is not the same as it was in January. In January, it was a surprise because it moved very quick and it didn't look like it would stop. And that caused a mass panic of a lot of big money holding shorts in the volatility futures. And they all came in to get out at the same time. Also at the time that the markets closed. There were orders for hundreds of thousands of short vol contracts. And of course, to close a short position, you got to buy it back. And for the past year and a half, everybody and their uncle was shorting back month vol futures. And to get out of a short position, what do? You got to buy it back. And that's what happened. We're not in a similar situation as that, but I will tell you, we can get up into this semi-red zone right up here that takes us north of about 2250. These zones are colored for strategy reasons. I just like to color them so it's easy for me and for our members to look at different option strategies, play more nicely in different color zones. So I just want to point out, for those of you that are not members, there are ways that we can trade volatility that give us about a track record, a proven, timed out track record of success of about 97%. And it's not what most of the market does. All right. We do it a little bit different, but it's got a great track record. So we're just waiting now for volatility to come back into play, and then we're going to get back into action again. So members, stand by, and we'll talk more about it this Sunday evening. If you're not a member, I highly encourage you to come in and check us out. So this is what we got going on. Now, one other thing I want to show you guys, let's take a look at the Dow Jones transports. As I showed you guys a couple of Sundays ago, I said, look, the Dow Jones transports are making new all-time highs. They were up here making new all-time highs back over a week ago. I said that is going to be very bullish, folks, for the Dow, because the Dow transports kind of lead the Dow. And now it's sitting up here. I think it's going to pull back a little bit. So we'll see a little bit of a respite or a little bit of a calmness in the markets as we digest this triple witching this past week, as all these options rolled out to the next expiry period, the futures, the index options, all these things. As soon as they roll out, we'll see a little bit more calmness, a little bit volume tighten back up a little bit. We'll see here on that. Now, the other thing I wanted to show you were emerging markets. We really had a good time. Look at China. China moved up over 4% for the week. Here it is way up here. Okay. That's a huge run off the lows. Now, China's down 33% for the year. That big move up back over its 50 EMA. I want to see if it can hold and get legs. Remember, any move up in emerging markets is subject to a sell-off, a sell or rally kind of thing, because emerging markets have been killed with these trade tariffs and with a stronger dollar. If the dollar starts to weaken, and we see money start to come back into the emerging markets, more like a by the value there, And I've been saying for about 2 or 3 weeks now, we could see money go back in on a relative basis to emerging markets versus the U.S. So we could see, even if the U.S. goes up a little bit, we'll see emerging markets go up stronger. So here's the China. They're up 4% this past week. Look at the Vanguard All World Index. It is also up here. Now, we're still well below the 2018 open, so we're still in the red for the year for the indexes. But look at the succeeding bullish divergences here. I mean, it's just beautiful. And these triggers here were great triggers to go along VEU. Okay, now keep in mind we've got a cross in the 50 and the 200, so the predisposition for this is to roll back over. I need to see us climb back up. I want to see, notice the vector of the 50 EMA is already turned up. The vector for the 200 EMA is flattened. So if we can consolidate here, and it could take, through the fourth quarter to get some consolidation, we could see a momentum shift and a change in emerging markets in China, and then see the markets turn, and on a relative basis, we may want to move some money in some other country ETFs. Okay. And speaking of emerging markets, if we look at emerging markets, here's the chart here. You can see here, just like all the others, we're off the bottom here. And we've captured the 50 EMA. Now, if you'll look over here on the left-hand side, this red line, let me just kind of dance it out a little bit. Going all the way back to March of this year, every time we've challenged this red line, which is the 50 EMA, we really didn't stay over it. Here we tried to, but we would close below, up, down, up, down. We never really got the escape velocity that we needed. Same thing right here. So now what we need to watch is, are we going to get some escape velocity from the 50 EMA here on price action on emerging markets? If we do, and we can come up and challenge the 200 EMA, that is where that key pivot high is, then perhaps we can break this trend line or this channel here. If I were to, let me just pencil it in for you. I think you guys probably already see it on, in your eye here, and it's not, I'm not doing it very straight, but you guys get the idea. So if we can take that out, and then we get above that pivot high right there, which is where the 200 EMA is. So let's say we move up, we have the requisite profit taking, and then we do some of these consolidations right here. And then we break out that right there. Basically, then we want to be happy pirates, because then we're going to be looking for gold in emerging markets. Certain emerging market country ETFs are going to go, batshit crazy. We're going to see some other stuff go. Meanwhile, the U.S. on a relative basis will be underperforming. We'll also see the dollar weaken against other currencies. That is what would happen should we get this breakout. Okay. Even though interest rates are going up, and you may go, well, why is the dollar getting weaker when interest rates are going up? And this is the reason, guys. That would be the reason. So that's kind of what we're looking at. If we look at treasuries and we'll look at bonds, it was up a little bit, but bonds is down very hard. Bonds came down and actually broke, let me just move it down here, actually broke my 2018 lows. Remember, my big term support area for bonds is this colored bar right here, from about 141 down to about 140. We came right down to it. We tested it here. We moved up here. Every time we get up in this area here, should we get back up there again? Remember, we were way down here in May, and we moved back up in less than a week and a half. We were back up here again. That was a huge move. If we move back up, then we're going to want to look at the puts or short bond futures. Puts and TLT are short bond futures, but we can see how bonds gave it up. Now, if I step out, let me just go out for a weekly here just to show you we're on the edge of bonds really breaking down here. You can see right here. Let's just move it out a little bit so that you've got a little bit more. This is a weekly chart. You can see right here on this weekly chart, as I've moved it out, we've got this huge volume over price right here. Now, this goes all the way back to 2011. So that is a fair value for bonds going back to 2011, around 143. We're at 140 right now. There is another fair value, not quite as strong, but a fair value, as I pointed out to you guys a week or so ago, down around 132, 133. Should this break right here, we're going to run from 139 to 132 pretty quickly. That would be the pivot low where we could overextend and then bounce back up into this fair value and chop around for about 6 months to a year until it figures where it wants to go again. Okay. All of these crosses are below the zero line. You can see here where all these crosses here above the zero line. And then all of a sudden in 2017, we've seen the whole cross line has been moved much lower. That suggests strength is coming out of the long bond regime and going more into the short bond regime. Now we're being held up nicely right here. But should it break, folks, puts and TLT would be a higher probability trade, or just playing it to the downside or in bond futures. Okay. So that's a little bit, and I've been telling our members this, and there are multiple ways to play this trade here. So that's kind of where we're sitting. Although we did have a little bit of a bounce. I would not be surprised to see a bounce back into a fair value here, fair value area here, which goes back about a year. Okay. But I'm telling you, there are a lot of people now with the rate hikes coming up. And if the emerging markets step to it and we see bonds kind of hover here or go down lower, we'll see emerging markets get stronger. We'll see money come back out of the U.S. And it'll further weaken the dollar, even though interest rates are going higher. All right, that's what puzzles a lot of folks. But that's the way these correlations are working right now, and we got to play them. All right, that's kind of how it is. If we look at currencies, well, it's the same thing, guys. If we look at the dollar right here, it's on a daily chart, right? You can see how the dollar has really broken down. This is why emerging markets are doing so good right now. Why commodities are coming back just a little bit, because the dollar has broken the 50, broken the 200, and then came back up, and now it's holding on for dear life. Okay, I would expect a little near-term rally, but any rally in the dollar index should be sold off. And by the same coin, if we look at the euro, which has got about it's 58% of the dollar index. Look at this right here. This has had a really strong rally off the lows here of $1.13 to the dollar. All the way up here, we've taken out both the 50 and the 200, and now it's sitting on the 200. So any pullback in the euro short term could be met by strength in the euro, okay? Because once Super Mario Draghi starts tightening the balance sheet there, and he's on record as saying he's not going to raise rates. He's going to leave them at a minus 10 basis points through 2019. But he may not have any control over the interest rates here. The markets are going to force him to do what he needs to do, right? So let's see how this thing plays itself out. Right now, it looks like this. It's a buy the dip kind of thing on the euro. Okay. Now the British pound, the Brexit really supported the British pound moving higher, but it really got chopped down hard this past Friday. They had a very bad meeting in Algiers. No, in Salzburg. I think that's where it was. Algiers is the oil meeting this weekend. We'll get into that later. But you can see here we just huge bearish engulf, almost not really a bearish engulfing technically, but pretty damn close. And it came all the way back down here. I'm rooting for the pound to come down even lower, so because I want to get long the pound. I think long term it'll be a good trade to do long. Right now, though, there's just too much headline news risk in what they do with the Brexit. Okay, they were supposed to come to terms and have kind of like a letter of understanding or a memorandum of understanding of what they're going to do come March. But if they don't have that agreed to, they're on record as saying we're splitting from the EU, even if we don't have a deal. That'll move the pound down with a lot of uncertainty baked in. So there'd be a lot of uncertain risk. And as you guys know, the markets hate, I mean, literally hate not knowing what's going to happen. So that unknown causes more risk to go into the markets, and human nature being human nature, we always overplay our hands both up and down. So let's see how this thing plays itself out. I wouldn't touch it right now, but once we get a little bit more clarity around that, I think the pound is going to be a really good trade. Okay. If we look at the gold market, okay, let me just focus on gold here for a second. Some people are saying, gee, is gold as the bottom end in gold, right? The gold, guys, is doing exactly what it did. As I pointed out last Sunday or over the weekend on our weekly roundup, what it did right here. We spent a month right here at the 1300 zone, all right? 1295 to 1305. And guess what we're doing right here? Same damn thing. You know, when we first broke the zone, we broke it, we went way below, and then we came up, and now we just chopped around in the zone. Here we went way below, and now we're chopping around in the zone again. Okay. Now, is it going to break the same way that one did? Unknown at this time. If emerging markets start getting stronger, the dollar gets weaker, we've got the propensity to break to the upside. Okay. If not, we're going to come down. My target was down in this area right here. Okay. Right around now, we've been down there before. We almost hit my target. We hit 1167.10. So maybe the target has been hit and the low has been made for this year. But I do believe over the next 2 years, gold will be higher. But right now, I think gold still has lower to go. Okay. Like the emerging markets, like the British pound, the 50s crossed the 200. The downward vector on both the 50 and the 200 are still pointing down. So that just means right now, most money, any rally, probably the odds favor a sell the rally rather than a buy the dip moment in gold. Same thing with silver. As you guys know, I'm playing silver to the upside longer term. I've got 16 strike puts that I can just keep rolling over, so I can sell silver all day long at 16. So that's keeping me satisfied in the trade. But I do believe silver is going to come back up. You can see, I mean, it really maps itself out very nicely. I'm going back now to going all the way back in time to around the first part of the year. You can see here the really nicely defined value areas going back since this year, right? These really become where buyers and sellers really duked it out. So these can be the levels. Right now, we're sitting right at that level. So we're kind of, this would be our R1, our first level of resistance. This would be our S1, our first level of support. So I expect us to fight this out. If we can take this value area right here back, it'll provide support. And if we see some escape velocity, we can move up to this next value area. Okay. This is the big one for the year. So silver, I don't see too much more downside, to be honest, in silver. I really don't. It's not like a stock. So investing in it longer term, to me, makes some sense. And of course, if we go out to a weekly chart, you can see, and let's just really step it out a little bit here. Look at all that value area there, right? I mean, we're way down here. The big value area in silver is right around 1660. Silver's at 1431 right now. Okay. We're down at the lower end of this value area here. And this goes all the way back to 2012. So that just shows silver wants to stay in this zone right here. Now, as you guys know, we had a sell signal on a really nice a technical pattern because we had that pattern like this, right? I mean, we had the upsloping pattern. It was a symmetrical triangle. We entered the triangle left to right, top to bottom, so that suggested a break to the downside. So right in that area there is where I just got my 16 strike puts. I just picked them up in case we did break down. We could have broken up, but the odds favored a break to the downside. And downside we broke, because if we had broken up, I just would have taken those off, right? But we broke down, so that just saved my tookus. So now my effective rate for silver is at that level. So I can withstand this move down here. Hell, I could even pick up more down here and take advantage of the lower prices down at this level, expecting silver to at least make its way back up to the value area here. Now, that may not look like a big move, but a $2 move on a $14.31 stock is what, 17, 18%, something like that. And so that's not a bad return over a 12-month period. And I believe it'll be back up there over a 12-month period. And it's a fairly conservative trade, right? So it's just, and you don't have to put a lot, you don't have to allocate a lot into the trade, but I'm just giving you a way to just have some play in the precious metals market. Copper, as I've been telling our members, so goes China, so goes copper, right? I said when China starts to get stronger, watch copper. Look at what copper did on Wednesday, Thursday, and Friday. When China started to improve, copper took off, like a Top Gun movie, right? Right into the danger zone. Now we're in a we're at a very strong resistance point. I would think copper's probably going to pull back down just a little bit. We got to watch it very closely. It got a little bit stretched. If you can't trade copper futures because it's a great trade, another way to play it is COPX, which is copper miners. Same thing. We got this move. You can just buy the stock. It moved from the lows down here around 20 up to 22.40. So about a 10% move really in just 2 days is what it did. Actually, a little bit more than 10% in 2 days. So it's a good trade. And you can see here in COPX, and if we put it on a daily chart, you can really see the strong move here. Okay, we're just now hugging the 50 EMA. I want to see if we can hold it. If we can, then, and watch China, because if you're going to trade copper or you're going to trade some of these emerging markets, you got to really watch China, because that's kind of control it. Energy, we got a whole lot of stuff going on in oil right now, a lot of stuff. We got the meeting in Algiers this weekend. What is OPEC going to do, right? Trump came out with a tweet on Friday. Oil is at $80 a barrel. Middle East, you get a lot of Saudi Arabia, you get a lot of support from the U.S., blah, blah, blah. We want to see oil lower, blah, blah, blah. Let's see what you can do. All of this, really, Trump is kind of driving anyway with the oil embargo on Iran that's due to take effect November 4th. Here's the upward vector. We broke it once, we regained it, we broke it again, and now we're trying to get back up above. I've on record is saying I think oil is going to go lower. All right. I had called 62.50. We came down here to about the low 64s, and then we've had this move up because of what's coming up with Iran. But I still think oil is going to go a little bit lower here in the WTI. I think Brent, the odds favor Brent to move higher. If we look at Brent futures, same trend line. But notice here, it's above the trend line, and it seems to be holding a little bit better, okay? Brent is going to be affected more so by the Iranian embargo November 4th than WTI, okay? And if we look at the difference between Brent and WTI, this is the spread. The spread has come in just a little bit, but I do believe the spread is going to start to widen again as we get closer to November 4th. Why? Because a lot of countries are going to stop buying Iranian oil. They got till November the 4th, essentially another 8 weeks, 10 weeks to figure it all out, to get oil elsewhere, right? South Korea, Japan, Europe is one of the bigger buyers of Iranian oil, India, China. Even China's playing along with the fuel embargo a little bit. And the reason why is some of them don't have any choice. They could say, screw you, Trump, we're going to buy from Iran, but they can't, because Trump is going to, as of November 4th, any insurance company that's insuring any oil tanker, if that oil is leaving the Iranian point, it will not be an insurance company that wants to do business in the U.S. So even if the insurance company that funds and insures these oil tankers are located in another country, they're not going to play that game, because they want to do business in the U.S. They want to sell insurance policies to U.S. companies. So they're not going to play the game. So it's kind of left Iran in a situation where only their tankers can work, and they don't have that many tankers, okay? So it's going to be real interesting. This is going to have the effect of basically taking oil off the international market. Now, Saudis and Russia and some of the others are meeting this weekend, as I said, in Algiers to figure out what they're going to do. All right. But that is going to probably make Brent a little bit more susceptible to higher upside moves than WTI. Because here in the US, we're not affected by what goes on in the Straits of Hormuz because we're almost energy dependent right now. And we're the world's largest exporter right now of oil, believe it or not. Really wild. So that's what's going on in the oil market. And this is the spread. When the spread got really wide back here, we were selling the spread. Right here, we may want to look at buying the spread, set some tight stops down around the 787 area. But that's kind of what we're looking at. Now, we've got some other things going on in the ag market. We haven't touched meats or softs yet, but that's where the markets are looking right now, guys. If you're not in our group, I highly encourage you to come in. I do believe while 2018 started off really wild and woolly and then kind of settled into a dragon move to the upside as we just kind of porpoised higher. I think as we go into Q4 and then we kick off 2019, there's going to be some prizes out there, some really big surprises, and we're going to have some great opportunities in the options market on volatility and a few others that we just want to take advantage of. Everybody have a great weekend, members. I'll see you this Sunday evening. So buckle up. The train has left the station, and next stop, let's see what happens. Hopefully the tracks are all working. See you guys later. Ciao.